Unless you've been living under a rock, you know that Donald Trump has imposed a lot of tariffs on various countries to various degrees. Pretty much all of the tariffs are in the double digits. The question is, what's going to happen now with the global economy? The market is already spooked, the stock market crashed, Bitcoin held up somewhat, but what's going to happen from here? Now here's the infamous picture. Donald Trump holding a table of various tariff rates, and he says those are reciprocal. In other words, he's claiming that Vietnam is imposing a 90% tariff on the US. In reality, this seems to be calculated based off trade deficits, not based off tariffs the other country is imposing. Here's the detailed overview: 34% for China, 20% for the European Union. Those are probably the main drivers. Now this will obviously decrease trade activity, and it will likely also increase prices in the US. Now there's been a lot of discussion whether or not this is actually good or bad for America. In the end, consumer prices rising is of course not that good for the middle class, but is it good potentially for the US government? Let's think about it this way. Let's say there is a product that costs $10 to produce in the US and it only costs, say, $9 when it's imported from somewhere else without tariffs. Once we impose the tariffs, of course that product from outside will be more expensive, thus the product in the US will be preferred. Thus, if there are products that are marginally cheaper to produce outside of the US, we will see the production move to the US. Now for products that are way cheaper to produce outside of the US, we will still see imports, because 20, 30 or even 40% tariffs won't move the needle if the price level outside of the US is that much lower. Now there is a real argument to be made that it might be worth it to increase slightly the production of some products when they are made in the US. Of course, the US itself becomes more independent, but also all the tax revenues then go to the US government. So when something is produced in the USA, all of the taxes that are connected with that production also go to the US government, right? We've got all the employment, we've got VAT, we've got all kinds of taxes that move to the US government. Now, if the consumer was to prefer a product out of Vietnam just because it's 5 or 10% cheaper, and then all of those tax revenues don't go to the US government but to the Vietnam government, then that's actually a net negative for the US nation. Yes, products might get slightly more expensive, but US tax revenue should get up much more in relation to that. Now, I don't think that the market is completely thinking this through yet. Now, there are different ways to calculate the rate of inflation. And there's a very nice measure called Trueflation that tends to measure things like housing and consumer prices a bit faster than the official data that's used by the Fed. And based on that metric, there's currently only an annualized inflation rate in the US of 1.3%. Officially, we are at 2.7%. Now, currently, we still have monetary tightening. So we've got the officially measured inflation rate in green, and we've got the target interest rate set by the Fed in white. So it now costs real money to borrow. It's 4.5% versus 2.8%, a delta of 1.7 percentage points. And what's likely going to happen over time is that consumer prices continue to rise. And so I actually disagree with what most people are thinking. There is this theory floating around that Donald Trump is intentionally crashing the economy in order to force the Federal Reserve to lower the interest rates. Because if interest rates are low, then the government can refinance itself cheaply. But when at the same time the measured inflation rates go up, then the Federal Reserve should rather tighten than loosen. Currently, we are still in tightening mode. Now, what we've got at the top is the S&P 500 relative to the US money supply relative to USM2. And what we've got over here is the dot-com bubble crash, and what we've got over here is the global financial crisis. At the bottom, we've got the Fed balance sheet. So the Federal Reserve bought a lot of bonds and other instruments to expand the money supply and to support nominal prices of assets. Bitcoin got also born during that crisis, and then we had a secondary expansion of the money supply. That was during COVID. So here, this is the COVID crash. And currently, stocks are coming back down again, and we still have monetary tightening. We've got high real interest rates, and we've got a reducing Fed balance sheet. In the past, the Federal Reserve acted only after the S&P 500 went down by 30 to 40%. Currently, it's down only 18%. When the whole tax system is getting revamped in the US, when the income tax goes down, but at the same time tariffs go up, then I think we can't really compare inflation rates that much anymore. Things are likely going to become more expensive, but household incomes after tax could go up more than that. Yes, the stock market has declined, but it's nowhere near a crisis. Because during a crisis, we tend to see the sharpest sell-off by technology stocks. We tend to see technology stocks going down more than regular stocks. So when we look at the Nasdaq 100 tech stocks relative to the S&P 500, so all the stocks in the US or all the major stocks, we should see a decline. And this is a very long-term chart. It starts in 1985. And again, we've got our boom and subsequent bust of .com. But have a look at how much technology stocks so far underperformed versus regular stocks. Not that much. We saw a much larger contraction in the year 2022. Things might have just started. And again, I think that whatever panic is coming could be a buying opportunity. Right now, we are still expensive. People also start to complain how the gold price suddenly went down. Isn't that surprising, right? When the S&P 500 is crashing, why is the risk of asset gold going down as well? The answer is gold really didn't go down that much. From the top to the bottom of this quote-unquote crash, it was less than 5%. So what we see at the bottom is the S&P 500. There was, of course, more of a correction there. But I want to show you something. A little piece of history that most people might not be aware of anymore. This year is the COVID crash in the S&P 500. And that crash brought Bitcoin down with it. Have a look at the gold price during that time. Gold initially also went down to then afterwards recover again. So what's happening here is a liquidity crunch. The market is anticipating less credit in the system and thus everything is going down. But I believe that gold will recover the fastest here. When liquidity re-enters the system, then people are going to get first into gold and just at the end into stocks. Now still, stocks I believe are expensive because when we look at historical price to earnings ratios, we are still very, very high. I've showed this chart several times on this channel, but yeah, this starts in 1871 and we are still at a Shiller PE of 31. So currently we have to pay for the future 31 years of earnings whenever we buy the average stock in the S&P 500. And there are times where we only have single-digit Shiller PE ratios. Those times don't happen too often, but still, 31 is historically high and we should come down at one point. And maybe we just started a historical crash. Maybe this will be known as the Trump crash or as the global trade crash or as the deleveraging event of artificial intelligence. Who knows? I think it's simply wise to be somewhat diversified and to own the things that tend to be cheap. Stocks are definitely not one of those things, especially technology stocks, right? Especially the hyped stocks like Tesla or Nvidia, etc. Now, the altcoin market looks extremely ugly for most people, right? Most people are losing right now. If you've got a diversified portfolio of various altcoins and you're still hoping for the recovery, chances are you're in the negatives quite a lot. But our community is different. Have a look. We are currently making gains, 50% over here, 73% over here, 62 over here. Sometimes we do small gains, sometimes we do big gains. Not every trade is a winner, but as per tendency, we currently make money by betting on falling prices of very weak altcoins. Since Christmas of last year, the market cap of the altcoins went down by 33%. And when we zoom out a little bit, we can see that the top that we reached during the time barely was higher than the top in 2021. So the altcoin market has a hard time beating Bitcoin long term. And at the same time, Bitcoin in its historical chart isn't really that low. Yes, we've seen a correction, but we could see much worse. At least historically, we have seen much worse. Isn't it somewhat surprising? In the last year, so in the last 12 months, Bitcoin actually gained. So to be a bit more exact, Bitcoin increased by 22.5%. But there aren't a lot of altcoins that did better than Bitcoin. In theory, the altcoins should be more risky than Bitcoin. When things are going up, they should also outperform. But we've only seen this for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 altcoins out of the top 100. 16 did better than Bitcoin. All the others did worse than Bitcoin. And even among the 16, 2 of them are just gold derivatives. So we've got Pax Gold and Tether Gold. So really, the vast majority of altcoins did very poorly, even during a time when Bitcoin did quite well. Another way to look at this is to see how much of all of crypto is currently in Bitcoin, or the Bitcoin dominance. And this tends to increase and is likely going to continue to increase over this year. The altcoins are simply performing very poorly. They tend to just rally when Bitcoin dominance is extremely high, at around 70%, but we are currently only at 62%. We are making money while others are losing, and that's not because we are smarter than others, it's simply because we are properly set up. We don't just bet and hope that everything will be alright. We see the things the way they are. Now, a lot of people are scared of shorting, of betting on falling prices, because of the potential risk. If you don't know what you're doing, you might lose all of your money. It's about proper risk management. It's about using the right platforms. It's about being set up in a way that's lasting long term. That's why there's more than 100 tutorial videos in the premium membership. So that's down below. It's thebitcoinstrategy.com. I'm of course also sharing my own trades. I do regular updates on where I see the market and what kind of short positions I open. That's also all part of premium. And so if you want to check it out, it's currently $125 per month. There's also a 1-week money back guarantee. So in case you don't like premium, just message me within the first 7 days and I'll refund you 100%. There's really zero risk for you. It's important to have a plan to still make money when other people are losing. And it gives us a lot of leverage, because once we bottom out at the end of the bear market and we've got all of that additional capital, then we can deploy this all while others don't have anything to deploy, right? That's then when we get the real kicker. So we're simply now growing by 20% here, 30% there. We have our small bets that we do over time. We grow our capital over time. And then while others are getting crushed, we have more money that we can then deploy towards the next 3, 4, 5x that then of course come with the next bull market. But right now it's better to bet on falling prices. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. See you in the next YouTube video or see you in premium. Cheers.